All right, welcome to the deep dive. We are jumping straight into the deep end today, tackling a topic that sounds maybe a bit dry, but is actually super critical for anyone in a partnership.
Yeah, we're talking about navigating the end of a partner's interest.
Exactly. If you're a partner, or thinking about becoming one, or even just trying to figure out how these things work when someone leaves, well, this deep dive is definitely for you.
It's a really complex area of tax law, no doubt about it. And getting the rules wrong can have some pretty big tax consequences.
Right. So we've got some comprehensive source material here that covers the main ways out.
Yeah, things like a complete withdrawal, selling your stake, or what happens with retirement or death. And crucially, the specific tax rules for each.
So our mission today is basically to cut through that complexity. We want to unpack the core ideas, look at the different ways out, highlight the key calculations.
And really get a handle on the tax results you need to be aware of. Think of it as your roadmap for when a partner decides to, move on.
Okay, let's dive into that first pathway then. The source calls it a complete withdrawal.
Right, or often you'll hear it called a liquidating distribution. It's where a partner completely cashes out, essentially. They get assets directly from the partnership in exchange for their ownership interest.
So the partnership itself is giving them assets to buy back their share.
Exactly. And the main rule here, the starting point for understanding the tax side, is about the partner's basis in the property they receive.
Okay, basis. Always important.
Always. So the partner's basis in whatever property they get is generally determined by their adjusted basis in their partnership interest right before the distribution happens.
So unlike maybe a regular distribution where the basis might just carry over from the partnership.
Right, this is different. In a liquidation, your entire basis in the partnership interest itself, it has to go somewhere. It gets zeroed out, and that basis amount essentially transfers over to the assets you receive.
Okay, that makes sense. The basis needs a new home because the partnership interest is gone. How do we figure out that adjusted basis number right before the distribution?
Good question. You typically start with their capital account balance at the beginning of the year. Then you adjust it for their share of everything the partnership earned or lost income, gains, deductions, losses, right up until that withdrawal date.
So updated to the moment they leave.
Precisely. And crucially, you also add in their share of any partnership liabilities at that specific moment. Remember, liabilities are part of a partner's basis.
Right. Debt counts.
That sum gives you the adjusted basis in the partnership interest. Then, the first thing you do is subtract any cash they receive in the distribution.
Cash comes off first.
Always. Whatever basis is left after subtracting the cash, that's the amount you then need to allocate to any non-cash assets they received, like property or equipment.
Okay, so basis gets reduced by cash, and the rest attaches to the property. Now, when does the partner actually have to recognize a gain or loss? Is it automatic if the property value is different from base?
That's one of the interesting things here. Unlike, say, selling stock, recognizing gain or loss right away in a liquidating distribution is actually quite limited. A partner recognizes a gain only if the amount of money and the tax code is very specific. It means cash only if the cash they get is more than their adjusted basis in the partnership interest.
Just the cash. So if they get $50 in property and $10 in cash, and their basis was $30, no gain is recognized immediately because the cash, $10, isn't more than the basis, $30.
Exactly. Receiving property, even valuable property, generally doesn't trigger gain at the time of distribution. The potential gain is deferred because the basis assigned to that property reflects it. You'll recognize the gain later when you sell the property.
Okay. What about recognizing a loss? Is that easier?
Actually, it's even harder. Loss recognition is super restricted. A partner can only recognize a loss on a liquidating distribution if two conditions are met. First, the only things they receive in the distribution are money, cash, unrealized receivables.
Which are like rights to future income for cash basis folks.
Right, like accounts receivable if you haven't booked the income yet. So cash, unrealized receivables, and inventory. That's the first condition, only those things.
Okay, only cash and those specific hot assets.
Pretty much. And the second condition is that the partner's adjusted basis in their partnership interest must be more than the partnership's basis in those specific assets they received. Cash plus the basis of the receivable inventory.
Wow. So if they get any other type of property, land, a building, equipment, anything, even if the whole package looks like a loss compared to their basis, they can't recognize that loss right away.
Correct. The tax rules basically force that leftover partnership interest basis onto that other property. The potential loss is baked into the basis of that asset, and they won't recognize it until they eventually sell or dispose of that asset down the road.
That is restrictive. And if a gain or loss is recognized under those narrow rules, what's its character? Capital.
Yeah.
Ordinary.
Generally, it's treated as a capital gain or loss. The reasoning is that the partnership interest itself is usually considered a capital asset.
Okay, but I sense a but coming.
Yeah, there's always a but in tax, isn't there? We'll need to talk about those hot assets, the unrealized receivables and inventory, because they can sometimes change the character of gain or loss relating to them, making it ordinary instead of capital. We'll circle back to that.
Got it. Let's try to make this clear with those examples from the source. Let's use TAG as our partner. First scenario. TAG's adjusted basis in his partnership interest is $24,000. He gets a liquidating distribution, $5,000 cash and some real estate. The real estate is worth $20,000, it's FMV, but the partnership's basis in it was only $10,000. What's TAG's basis in that real estate?
Okay, apply the rule. Start with tax partnership basis, $24,000, subtract the cash received, $5,000. That leaves $19,000.
So $19,000 remaining basis.
Right. That entire remaining $19,000 becomes TAG's basis in the real estate he received. It doesn't matter that the partnership's basis was $10 or the FMV was $20K. His basis is determined by his partnership basis after cash.
And does TAG recognize any gain or loss here?
Nope. No gain because the cash, $5K, wasn't more than his basis, $24K. And no loss because he received other property, the real estate, not only cash and hot assets. Any potential gain or loss is deferred in the $19K basis of the real estate.
Okay, scenario 2. Same $24,000 starting basis for TAG. This time he gets $25,000 in cash, plus the same piece of real estate. FMV $20K, partnership basis $10.
Yeah. Okay. Now the cash rule kicks in. He received $25,000 cash. His basis was only $24,000.
Cash received is more than basis.
Exactly. By $1,000, $24K. That $1,000 excess cash is recognized immediately as a capital gain.
Okay, so he has a $1,000 gain. What about the basis in the real estate he also got?
Well, his partnership basis, $24,000, was completely used up by the cash distribution, $25,000. And in fact, the cash exceeded it, triggering the gain. Once cash eats up all the basis, any other property received in that same distribution gets a zero basis.
Zero basis for the real estate, wow.
The basis calculation stops once the cash exceeds the partnership interest basis. Nothing left for the property.
Okay, third alternative. TAG still has his $24,000 basis. He receives $20,000 in cash and nothing else. No real estate, no other property.
This one triggers a loss. Why? Because he received only cash and his basis, $24K, was more than the cash he received, $20K.
Meets the conditions for loss recognition.
It does. He received only assets that can trigger a loss, just cash here. And his outside basis exceeds the basis of assets received. So he recognizes the difference as a loss. $24,000 basis minus $20,000 cash equals a $4,000 capital loss recognized right then.
That rule about only cash out assets for loss is really the gatekeeper. Okay, final TAG scenario involving those hot assets, $24,000 basis again. He gets $5,000 cash, plus unrealized receivables or inventory. The partnership's basis in those hot assets was $10,000.
Right. This is the classic loss scenario setup. Check the conditions. Did he receive only cash and hot assets? Yes, $5K cash and $10 basis of inventory receivables. Is his partnership basis, $24K, more than the total partnership basis of the assets received? $5K cash plus $10 hot asset basis of $15K? Yes, $24K is more than $15K.
So loss recognized, how much?
Yes. The source calculates the loss as partner's basis, $24,000 minus cash received, $5,000, minus the partnership's basis and the hot assets received, $10,000. So $24,000, $5,000, $10,000, $9,000. He recognizes a $9,000 loss.
Got it. It's partner basis, less cash, less partnership basis of hot assets received. That $9 kilo loss is capital. Unless
the specific assets, the receivables or inventory, would have generated ordinary income if sold by the partnership. If so, the character of the loss could potentially be ordinary, at least in part, and his basis in those receivable inventory he received.
what is his basis in them? Does it get stepped down?
No, for hot assets received when a loss is recognized this way, his basis in them is the same as the partnership's basis just before the distribution, so $10,000. This prevents getting an artificial step down on ordinary income assets.
Okay, these single asset or cash-only examples definitely help clarify the core gain and loss rules, but reality is often messier. What if a partner gets a whole mix of stuff cash, some inventory, some land, maybe some equipment, all in one liquidating distribution?
Ah, yes. Now we get into the real fun. When multiple types of non-cash assets are distributed, that remaining partnership basis, after subtracting cash, has to be allocated among them. And there's a specific pecking order.
An order of allocation.
Yes. Basis always goes to cash first, conceptually reducing the partnership interest basis. Then, any leftover basis is allocated first to any hot assets received inventory and unrealized receivables. Whatever basis remains after that gets allocated to the other property category, things like land, buildings, equipment, stocks, etc.
Cash, then hot assets, then other property. What if there are, say, 2 pieces of land in the other property bucket, or maybe 2 types of inventory in the hot assets bucket?
Yeah.
How do you split the basis allocated to that category between the multiple assets within it?
That's where it gets even more detailed. The source lays out a specific 3-step process for allocating bases within those categories if needed. And the mechanics of this process depend on a comparison we need to make.
A comparison between what?
Between the partner's basis and their partnership interest, let's call that their outside basis, and the partnership's total basis in the non-cash assets being distributed, let's call that the aggregate inside basis of those distributed assets.
Okay, define those terms clearly again. Outside basis is.
Outside basis is the partner's own adjusted basis in their partnership interest itself, like tags 24K or the numbers we'll see in the next examples. It's their basis in the ownership.
An inside basis.
Inside basis refers to the partnership's own adjusted basis in its assets. When assets are distributed, we look at the partnership's inside basis in those specific assets.
Got it. Outside, partner's interest basis. Inside, partnership's asset basis. And this 3-step allocation dance depends on whether the partner's outside basis is less than or more than the partnership's inside basis in the distributed non-cash assets.
Exactly. The whole point of this allocation process is to make the partner's final total basis in all the assets they received, cash included, exactly equal their outside basis in the partnership interest, effectively zeroing out that interest basis.
Okay, let's tackle the first comparison. Partner's outside basis is less than the total inside basis of the non-cash assets distributed. This means the basis of the assets received will have to be reduced from the partnership's numbers to match the partner's lower outside basis.
That's the scenario. Here's the 3-step process when outside basis is lower.
Step 1.
Step 1. Assign a tentative basis to every non-cash asset distributed. This tentative basis is simply the partnership's own inside basis in that asset. Copy-paste the partnership's basis onto each non-cash asset for now.
Okay, start by mirroring the partnership's basis for everything but cash.
Correct. Step 2. Now, you look only at the assets in the last property category distributed. Based on our order, cash, hot assets, other, this is usually the other property category, like land, buildings. If no other property was distributed, then it's the hot assets category. Within this last category, identify any asset that has depreciated, meaning its tentative basis from step 1 is higher than its current fair market value, FMV. You must reduce the tentative basis of each such asset down to its FMV. This is a required downward adjustment.
So step 2 forces a basis cut, but only for loss assets, and only within that lowest priority category. Why just the last category?
It's just how the rules are structured. The idea is to apply the necessary overall reduction first to assets that have already declined in value, and specifically within the category that gets basis last anyway. It preserves basis in the higher priority categories, cash, hot assets, and in appreciated assets within the last category.
All right, hit the loss assets in the last bucket first, down to FMV. What's step 3?
Step 3. After you've reduced the partner's initial basis by cash and made any step 2 basis reductions, you compare the partner's remaining target basis, which is their original outside basis minus cash, to the total adjusted tentative basis of the assets after step 2. In this scenario, outside basis, inside basis, the adjusted tentative basis will still be too high. You need to reduce it further. This remaining required reduction is allocated among all the assets in the last property category, but this time the allocation is based on their relative adjusted basis after any step 2 adjustments. This final adjustment further decreases the basis assigned in steps 1 and 2.
Okay, allocate the remaining necessary decrease across all assets in the last category, proportionally based on their post-step 2 adjusted basis. Sounds like we need numbers.
Definitely. The source uses Gertie. Example 1. Gertie's outside basis is $229,000. He gets $4,000 cash, inventory, partnership basis $10, FMV $15K, land A, partnership basis $200, FMV $150K, and land B, partnership basis $100, FMV $300K.
Okay, let's check the comparison. Outside basis $229K, inside basis of non-cash assets $10 EV plus $200 K. land A, plus $100 land B equals $310. So outside basis $229K is indeed less than inside basis $310. Asset bases need to come down.
Correct. His final basis in the assets must total $229K. Let's walk through it.
Please do.
Gertie's starting basis, 229 cash assets, is $225,000. This is our target total for inventory, land A, and land B.
225K is the target.
Step 1. Assign tentative basis, partnerships basis. Inventory $10,000, land A $200,000, land B $100,000. Total tentative basis equals $310,000.
Okay, $310K tentative. But we need to get to 225K. That's a total reduction needed of $85,000. 310K, 225K.
Exactly. We need to decrease basis by $85K total. Step 2. Look at the last category, other property, land A, land B. Any depreciated assets, basis FMV, yes, land A, basis 200K, FMV 150K. It's depreciated by 50K. We must reduce land A's basis down to its FMV. So decrease land A basis by $50. Land B is appreciated, so no step 2 adjustment for it. Total step 2 adjustment, again, is $50,000.
Okay, we've accounted for 50K of the needed 85K reduction. We still need to reduce basis by another $35,000, 85K, 50K.
Right. That remaining $935,000 reduction happens in step 3. We allocate this $935K across all assets in the last category, land A and land B, based on their relative adjusted basis after step 2. What are those bases now?
Well, land A's basis was $200K, reduced by 50K is in step 2, so it's 150K now. Land B's basis wasn't touched in step 2, so it's still $100. Total adjusted basis in the category is 150K plus 100K, so 250K.
Perfect. Now allocate the $935K reduction based on those relative bases. Land A, 150K at 250K equals 60%. Gets 60% of $935K equals $31,000. Land B, 100K at 250K equals 40%. Gets 40% of $935K equals $14,000.
Okay, so land A gets hit again by 21K, land B by $14. Now, what are the final bases for everything Gertie received?
Let's sum it up.
$4,000 received.
$10,000, step 1 only, not in last category, no adjustment.
Started at $200K, step 1, minus 14K, step 3, equals $86,000 final basis.
Let's check the total basis received. 4K plus 10K plus 129K plus 86K equals $229,000. Bingo. It matches his starting outside basis.
Exactly. His partnership interest basis is now 0. The total basis of the assets he holds now perfectly matches the basis he used to have in the partnership interest. It required stepping down the basis from the partnership's level.
Phew. Okay, that's one side of the allocation coin. Now the other, partner's outside basis, is more than the total inside basis of the distributed non-cash assets. Here, the asset bases need to be increased to soak up the partner's higher outside basis. Right. Same 3 steps, but the adjustments in step 2 and 3 work in reverse. They increase basis.
How does it work when we need to step up the basis?
Step 1, still the same. Assign tentative basis to non-cash assets equal to the partnership's inside basis.
Copyist again.
Step 2. Again, look only at the last property category distributed. This time, identify assets that had appreciated FMV basis. You must increase the tentative basis of these appreciated assets, but only up to their fair market value. This is a required upward adjustment capped at FMV.
So, step 2 bumps up the basis of appreciated assets in the last category, but stops at market value, prevents inflating basis beyond reality.
Exactly. Then, step 3, compare the partner's remaining target basis, outside basis minus cash, to the total adjusted tentative basis after step 2. In this scenario, outside basis, inside basis, the partner's target basis will still be higher. You need to increase the asset basis further. This remaining required increase is allocated among all assets in the last property category, but this time the allocation is based on their relative fair market value.
Key difference. For the decrease, step 3 allocation was relative adjusted basis. For the increase, it's relative FMV. Why the change?
Because you're allocating an increase, essentially adding value reflected by the partner's higher outside basis. Allocating based on FMV directs that extra basis towards the assets that currently hold more value.
Makes sense. Let's use Gertie example 2. Same assets. $4K cash, inventory, basis $10, FMV $15, land A, basis $200, FMV $150K, land B, basis $100K, FMV $300K. But now Gertie's outside basis is much higher. $529,000.
Okay, comparison check. Outside basis, $529K. Inside basis of non-cash assets is still $310K, 10K plus 200K plus 100K. Outside is definitely greater than inside. Asset bases need to go up.
Walk us through the increased steps.
Gertie's starting basis, $529,000. Subtract cash. $4,000. Remaining basis to allocate is $525,000. That's our target total for the non-cash assets.
Of 125K target.
Step 1. Assign tentative basis, partnerships basis. Inventory $10,000, land A $200,000, land B $100,000. Total tentative equals $310,000.
Okay, $310K tentative, but we need to get to 525K. It's a total increase needed of $215,000, 525K. The hard 2 and 10 door.
Right. We need to add $215K to the basis. Step 2. Look, the last category, other property, land A, land B, any appreciated assets, FMV basis, yes, land B, FMV $300K, basis $100. It appreciated by $200. We must increase land D's basis up to its FMV, so increase land B basis by $200K. Land A is depreciated, so no step 2 adjustment. Total step 2 adjustment plus $200,000.
All right, we've added 200K of the needed 215K increase. We still need to increase basis by another $15,000. $215K.
$200K.
Correct. That remaining plus $15,000 increase happens in step 3. We allocate this plus $15 across doing all assets in the last category, land A and land B, based on their relative fair market value.
What are the FMVs?
Land A FMV is $150,000. Land A FMV is $350K is $150K plus $300K plus $450,000.
Okay. Allocate the plus $15K based on relative FMV. Land A, $150K, $450K equals 13. Gets 13 of plus $15K plus $5,000. Land B, $300K, $450K equals 23. Gets 23 of plus $15K plus $10,000.
So the land A gets a $5K bump. Land B gets another $10K bump. Final basis.
Let's tally.
$4,000.
$10,000. Step 1 only.
Started at $200K, step 1, plus $5K, step 3. Fuse $205,000 final basis.
Start at $100K, step 1, plus $200K, step 2, plus $10K, step 3, equals $310,000 final basis.
Check the total. $4K plus $10 plus $205K plus $310K equals $529,000. Perfect match again to his starting outside basis.
And his partnership interest basis is 0. This shows how the asset bases were stepped up from the partnership's level to absorb his higher outside basis. The core takeaway is that liquidating distributions force the partner's outside basis onto the assets received, whether it requires a step up or step down.
And this really highlights that passkey difference the source mentions. Non-liquidating distributions are capped. You can't give an asset more basis than the partnership had in it, but liquidating distributions must zero out the partner's interest basis, pushing that entire amount onto the assets, adjusting their basis up or down as needed.
Couldn't have said it better myself. Liquidation is the final act. The basis has to land somewhere, and it lands on the distributed property.
What about the partnership itself? Does it recognize gain or loss when it makes these liquidating distributions?
Generally, no. The partnership usually doesn't recognize gain or loss just for distributing assets out to a partner in liquidation. It's seen more as dividing up the property. Now, if the partnership had to sell assets to get cash for the distribution, that sale would trigger gain or loss that flows through to the partners before the liquidation calculation, affecting their final basis. But the distribution itself, typically tax neutral for the partnership entity.
Okay, that feels like a solid understanding of the complete withdrawal path. Let's shift gears to the second major way out, selling the partnership interest.
Right. This is different because you're not getting assets from the partnership. You're selling your ownership stake to someone else. Could be another partner, could be a totally new person.
And the basic rule here is simpler.
At first glance, yes. Selling a partnership interest is generally treated like selling any other capital asset, like stock. So the selling partner usually recognizes a capital gain or loss.
How's that gain or loss calculated? Simple sale price minus basis.
Pretty much. You compare the amount realized from the sale to the partner's adjusted basis in their partnership interest right at the time of sale.
Okay, what goes into the amount realized? Is it just the cash they get?
It's the cash, plus the fair market value of any other property they might receive from the buyer. And here's the critical part, often missed. It also includes the selling partner's share of any partnership liabilities that the buyer effectively takes over.
The debt relief again. So if I sell my interest for $50 cash, but the buyer also takes over my $20 share of partnership debt, my amount realized is actually $70.
Exactly right. That debt relief is treated as if the buyer paid you an extra $20K. So $70 amount realized. You compare that $70K to your adjusted basis.
And the adjusted basis calculation is similar to before. Capital account plus income loss share up to sale date plus share of liabilities.
Yep, exactly the same logic to get the basis number you compare against the amount realized.
The source has Christie selling her interest for $15K cash, and the buyer assumes her $5K share of liabilities. Her amount realized is
$15,000 cash plus $5,000 liability relief equals $20,000 amount realized. That 20 times is compared to her basis to find her gain or loss.
Seems straightforward, usually capital gain or loss. But you mentioned hot assets affecting liquidations. Do they mess things up here too?
They absolutely do. This is probably the biggest complication in selling a partnership interest. The tax code has rules to prevent partners from converting potential ordinary income into capital gains just by selling their interests.
How does it work?
Any part of the gain from selling the interest that is attributable to the seller's share of the partnership's hot assets gets recharacterized. It's pulled out of the capital gain calculation and treated as ordinary income.
Why do they do that?
Because if the partnership had sold those hot assets directly, the income would have been ordinary. Or if the partner received them in a distribution and sold them, it likely would have been ordinary. The rule prevents using the sale of the interest as an end run around ordinary income treatment.
Is the definition of hot assets for a sale the same as for distributions? You mentioned cash, unrealized receivables, inventory before.
It's similar, but slightly broader for sales. For selling an interest, hot assets include inventory, unrealized receivables, especially for cash basis partnerships, and potential depreciation recapture.
Depreciation recapture, how does that work here?
You basically have to calculate how much ordinary income would be recognized due to depreciation recapture if the partnership had sold its depreciable assets, like buildings or equipment, at their fair market value right when the partner sells their interest. That potential recapture amount is treated as a hot asset attributed to the selling partner's share.
So the total gain on selling the interest might actually be split. Part ordinary income from the hot assets and the rest capital gain.
That's exactly how it works. You calculate the total gain, then figure out how much of it relates to your share of hot assets, including that potential depreciation recapture. That piece is ordinary income. The remainder is capital gain, can also apply to losses in some cases.
Okay, that adds a layer. What about timing? If a partner sells mid-year, how does the partnership's income or loss for that year get allocated?
Good point. You can't just have the buyer get all the income or loss for the year. The partnership's tax items, income, gain, loss deductions for the entire year have to be allocated between the seller and the buyer.
How do they split it?
Usually it's done pro rata, based on the number of days each person owned that specific interest during the partnership's tax year. Or sometimes the partnership agreement might allow for an interim closing of the books on the sale date, which is more precise but more work. Pro rata daily allocation is common.
Let's use the source example. Partner A has a 20% interest, sells it all to Partner B on March 31st. The partnership's income for the full calendar year is $80,000. How much does A get?
Okay, Partner A owned the interest for 90 days, Jan. Foreign Mar 31, assuming non-leap year. The total income attributable to that 20% share for the whole year would be $80,000. 20% equals $16,000. Partner A's prorated share is $16,000, 90 days, 365 days. That comes out to about $3,945.
So A reports $3,945 of partnership income for the year, even though they left in March. And B,
Partner B owned that 20% interest for the other 275 days, 365.90. Their share would be $16,000, 275 days, 365 days, which is about 12,055 days. The two pieces add up to the $16,000 total for that 20% share.
okay, that allocation makes sense. So we've covered liquidation and sale. What's the third main path the source mentions? Retirement or death payments.
Right. This applies when the partnership itself makes payments directly to a partner who is retiring or to the estate or successor of a partner who has died, specifically to liquidate their interests.
How is this different from the liquidating distribution we talked about first?
Yeah.
Sounds similar.
It can be similar, but the key difference often lies in how the payments are structured, especially in retirement scenarios. The tax treatment hinges on classifying these payments.
That's fine. How?
The tax code generally splits these payments into two categories. First, payments made in exchange for the partner's interest in the partnership's assets. Second, other payments.
Payments for assets versus other payments. What's the tax treatment for each?
Payments that are clearly identified as being for the partner's share of partnership assets are generally treated like a liquidating distribution or a sale of that asset share. This usually results in capital gain or loss for the retiring partner or the deceased partner's successor, measured against their basis in that share of assets. Hot asset rules can still apply here, too.
Okay, payments for assets, capital gain loss territory, generally. What about those other payments? What are they typically?
Other payments often represent amounts paid out that are not directly tied to the value of specific partnership assets. Think of things like ongoing payments based on a percentage of future partnership income, or sometimes guaranteed payments made regardless of partnership income.
And how are those taxed?
These other payments, especially if they're based on partnership income, get treated very differently. They're generally considered a distributive share of partnership income or a guaranteed payment. This means they are taxed to the recipient as ordinary income.
Ah, so ordinary income, not capital gain. The way the retirement or buyout agreement is written seems critical here.
Absolutely critical. Whether a payment is designated as being for assets, potentially capital, or as an income share or guaranteed payment, ordinary, dramatically affects the tax outcome for the person receiving the money. It also affects the tax treatment for the remaining partners, as ordinary income payments are often deductible or reduce the income allocated to them.
Okay, that distinction is huge. Now, throughout this, we keep bumping into basis, outside basis, inside basis. The source brings up something called the Section 744 election and the Section 743B adjustment. This seems related to transfers, like sales or death.
Yes, this is a really important mechanism specifically designed to deal with discrepancies between a new partner's outside basis and their share of the partnership's inside basis.
Why would there be a discrepancy?
Think about it. Someone buys an interest, they pay fair market value, right?
Yeah.
But the partnership's basis in its assets, the inside basis, might be much lower due to depreciation or just historical cost. Or if someone inherits an interest, their outside basis gets stepped up to FMV at the date of death, which again probably won't match their share of the old inside basis.
So the new partner's cost, or inheritance value, outside basis, doesn't align with their proportional share of the partnership's tax basis in the assets, inside basis.
Exactly. Without an adjustment, that new partner could get hit with taxable gain when the partnership sells an asset, even though that gain economically occurred before they bought in, or they might not get depreciation deductions that reflect their actual investment cost.
So the Section 754 election is the fix. Who makes it?
The partnership makes the election. It's optional in most cases. If the partnership has a 754 election in effect, then whenever there's a transfer of a partnership interest, by sale or death, a special basis adjustment is calculated. This is the Section 743B adjustment.
And what does the 743B adjustment do?
Its purpose is to adjust the partnership's inside basis in its assets, but only with respect to the transferee partner, the buyer or inheritor. The adjustment amount is the difference between the new partner's outside basis, their purchase price or date of death value, and their proportionate share of the partnership's existing inside basis in its assets.
Can it go both ways, increase or decrease basis?
Yes. If the outside basis is higher, it's a positive adjustment, a basis step up for that partner's share. If the outside basis is lower, it's a negative adjustment, a basis step down. This adjustment is then allocated among the partnership's various assets according to complex rules, Section 755.
And this adjustment, it only affects the new partner, not the old partners.
That's the crucial part. It's a personal adjustment just for the transferee partner. It doesn't change the partnership's common basis calculations for figuring overall income or loss, and it doesn't affect the other partner's share of basis or gain loss. It's like the new partner has a separate layer of basis adjustments applied just to their calculations.
So it prevents them from recognizing the built-in gain or loss that existed before they joined related to their share.
Precisely. It aligns their share of the inside basis with their actual cost or inherited value. It's also worth noting, if there's a substantial built-in loss when the interest is transferred, meaning inside basis is much higher than the value, specifically by more than $250,000, this 743B adjustment becomes mandatory even if the partnership doesn't have a 754 election in place.
Let's use the Oscar Bernice example to see it work. Oscar buys Bernice's 25% interest in Handley Partnership for $500,000. Handley has a 754 election active. The partnership's only asset is a building with an inside basis of $1.2 million and an FMV of $2 million.
Okay, first, what's Oscar's share of the partnership's existing inside basis in the building? Total inside basis is $1.2 million. His share is 25%. So 0.25, $1.2 million, $300,000.
His outside basis is what he paid, $500,000. His share of the inside basis is only $300,000. There's a $200,000 gap.
Right. So the Section 743B adjustment is $500,000 outside basis minus $300,000 share of inside basis plus $200,000. This is a positive $200 basis adjustment specifically allocated to Oscar's share of the building.
So just for Oscar, his basis related to the building is effectively $300 plus $200K, because $500K.
That's right. Now let's see the impact. Suppose the partnership sells the building later for its $2 million FMV. The partnership's overall gain is $2 million sale price minus $1.2 million partnership basis is $800,000 gain.
Normally, Oscar's 25% share of that 800K gain would be $200,000.
But thanks to his $200,000 positive 743B adjustment, his calculation is different. His share of the proceeds is $2 million, 25% equal $500,000. His effective basis for calculating his gain is his share of inside basis, $300K, plus his adjustment, $200, totaling $500. So his gain is $500,000, proceeds minus $500, its adjusted basis equal dollars.
Wow. So the adjust completely shielded him from the gain that was already built into the asset when he bought his share.
Exactly. It perfectly offset his share of the pre-acquisition appreciation. The source notes the total taxable gain recognized by the partnership would be $600,000 in this case, $800K total gain minus Oscar's $200K shielded portion. That $600K gain gets allocated only to the other partners. It shows how powerful the 5743B mechanism is for the incoming partner.
That really clarifies the purpose of that election. Okay, this has been incredibly detailed. We've really covered the waterfront on how a partner's time with a partnership might end.
Yeah, we hit the big three. The liquidating distribution, where basis has to zero out, the sale to another party, generally capital gain, but watch those hot assets, and the retirement or death payments, where categorization is key.
And woven through it all is basis, how it's calculated, how it moves, how it impacts gain or loss.
Yeah.
Plus that crucial Section 754 concept for transfers.
It underscores that how you leave a partnership matters immensely for tax. The method, the assets involved, the agreements in place, they all drive the final tax bill.
So for anyone listening, whether you're in a partnership, thinking of joining, or advising one, knowing these different pathways and their tax consequences is just fundamental for planning and making informed choices.
Definitely. Understanding how basis gets allocated in liquidation, or how liabilities and hot assets impact a sale, or how retirement payments get taxed, or the benefit of a 754 election. It all feeds into smarter structuring and exit planning.
Which brings us to a final thought to leave you with. We've seen just how different the tax outcomes can be depending on the exit method and the assets. Given that complexity, how might a deep understanding of these exit rules actually influence how you structure a partnership agreement, or even decide whether to enter a partnership in the first place?
Something to chew on. Planning the end game right from the beginning might save a lot of headaches down the road.
Indeed. That's all for this deep dive.